What's up everybody, welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony, let's jump in. Okay, happy Monday everybody. I hope you're all having a lovely start to the week. It was not a happy Monday, of course, for investors in the Chinese stock market. The CSI, China Securities Index 300, a capitalization-weighted stock market index designed to replicate the performance of the top 300 stocks traded on the Shanghai Stock Exchange and the Shenzhen Stock Exchange, plunged 5% today. One of the worst daily performances the index has ever seen. Shanghai's technology-heavy Star 50 index lost 6.13% value today too. The onshore yuan slumped to its weakest level in 17 months on concerns about rising capital outflows and as oil sank below $100 a barrel. The renewed selling of Chinese stocks likely underscores market fears over China's outbreak and worsening lockdown situation, especially now that restrictions are being introduced in the capital city of Beijing. More on this soon. Quote, "There are concerns about the COVID situation in Beijing evolving into what happened in Shanghai, with some prolonged lockdowns that bite the economy." End quote. And, quote, "Economic conditions will continue to remain impaired with its zero-COVID stance. Overall, the sell-off may have been further exacerbated by the dent in global risk sentiments, with the lack of positive catalyst for market participants to take on added risks for now." End quote. By the way, you're likely seeing right now stock footage of red arrows going down representing the stock market hit that the country experienced today. Just note that within mainland China, actually when prices go down, it's often displayed in green, and when prices go up, it's often displayed in red, the complete opposite to what we see in many Western countries. Anyway, let's continue. Investors may also be frustrated over a lack of follow-through on policy promises to support growth and stabilize capital markets made by the government. Or it could be that the worry is that the current policy support that the government has implemented so far isn't enough because of new COVID lockdown policies. Pessimism is very much in the air. One of China's best-performing hedge funds, the Shanghai Banxia BANXIA Investment Management Center, is warning that 2022 will be worse than the global financial crisis for China, cutting its stock exposure to zero in anticipation of a worsening economy in the country and further plunges in Chinese equities. Banxia's fund manager expressed, quote, "This year could be even worse for fund managers than 2008. It's now very difficult to find a place where they can make money." End quote. The mainland stock sell-off also hit other major markets in Asia, with benchmarks from Japan and South Korea falling more than 1%. The Hang Seng Index in Hong Kong sank 2.6% today also. We will be unpacking the market reaction to this crash more in tomorrow's video. Okay, next up, the Shanghai lockdown and concerns with the situation in Beijing and other places. Shanghai residents woke up to the city's 24th day of strict lockdowns this morning, Monday morning, and with cases and deaths both jumping over the weekend, hopes that maybe the financial hub of 25 million would be turning a corner last week have been replaced with frustration and renewed uncertainty. After almost 4 weeks, residents are still unsure when normalcy can return to their city. Indeed, things may be getting worse. This morning we learned that Shanghai's fatalities for COVID-19 have risen to a record 51 deaths, amid a 76% jump in the number of symptomatic cases. Symptomatic cases jumped to over 2,400 in the previous 24 hours, compared with just over 1,400 the day before that. Though infections in the city were down, overall infections were down about 7.5% from the day before. National infections have increased, however. We also need to keep in mind those are official numbers. Several districts are now enjoying a relatively stable flow of food and medical supplies. However, stories of shortages are still being reported among many communities. Over the weekend, Shanghai authorities built barricades inside residential complexes in some districts of the city to prevent people in high-risk lockdown areas from entering so-called low-risk areas. Videos of the erection of these barriers were shared online, drawing strong criticism from many residents. Yesterday, Sunday, the central government, through a statement with the Vice Premier Sun Chunlan, backed the measures, expressing that they were, quote, necessary to control the spread, end quote. State media over the weekend continues to insist that China's zero-tolerance policy is the best policy for the country. Meanwhile, authorities in the wealthy district of Chaoyang, home to just over 3.45 million people in the capital of Beijing, late yesterday evening ordered residents to be tested 3 times this week. Concerns that a Shanghai-style lockdown could be coming for the city sparked runs on supermarkets as residents tried to stock up on food and other essentials. As we discussed before, Chinese stocks crashed with investor fears of lockdown and what it would mean for China's economy. By Monday afternoon, Beijing Times State Television was reporting that movement restrictions in one part of Chaoyang were tightening, with residents being told not to leave the area. Beijing officials have warned of more cases in coming days, and in the coming days we will also be following both Beijing and Shanghai very closely. Finally, we continue to follow the developments in the crisis at property sector. But quickly guys, as always, if you enjoyed the content, don't forget to hit the like button. It's a huge help. And for anyone who wants to go the extra mile or show your appreciation for the content and help keep this channel and this sort of content sustainable, Patreon, Buy Me a Coffee, and crypto links are in the description below. As always guys, thank you very much everybody for all the support. Yesterday we discussed a piece from the National Business Herald which reported on the housing situation in the provincial capital of Henan, Zhengzhou, home to 12.6 million people. Despite a series of easing measures from the local government to promote home buying again, the market has not rebounded, or even stabilized for that matter. This is very much a red flag. Zhengzhou's property stimulus package was one of the most aggressive in the country this year and was deemed necessary to rescue the sector from another disastrous year. Many analysts are now exploring this case study to see what it could mean for the national housing market. Yesterday, the UK-based Japanese-owned Financial Times published an excellent piece too on Zhengzhou, opening with an observation from a local real estate agent who expressed, quote, the stimulus measures aren't enough to offset negative factors that are showing little signs of easing, end quote, explaining that these factors include COVID-19 restrictions and falling household incomes. Quote, compared with the same period last year, new home sales in Zhengzhou fell more than 30% in the 6 weeks from March 1st to mid-April, mirroring a nationwide trend. The city, the provincial capital of Henan province, and just 2.5 hours south of Beijing by high-speed rail, requires all arrivals to quarantine for 3 days. End quote. Real estate brokers in the city said that the flow of property buyers from other cities or provinces, who once represented half of their sales, a sign of speculation-driven buying, had ended. Of course, we know that the market was already in trouble before the latest round of lockdowns. However, many analysts had focused on the supply side of the market, pointing out that it was the crises of the developers that was really pulling down the market. However, it is becoming increasingly clear, as we have been saying for months now, that this is very much a demand-side crisis too. Not only because consumers have lost confidence in the market, but because incomes have been hit too. Last Monday, the National Bureau of Statistics said housing construction starts had fallen 20% in the first quarter year-on-year, even though at least 60 other cities have implemented property support measures to boost buying of properties. Nationwide, household savings increased 17% over the first 3 months of this year, while their new debt, composed mainly of mortgages, fell 46%. Of course, many of us saw this coming. This is what China finance expert at Peking University, Michael Pettis, observed yesterday. Quote, speculative markets can't be stabilized. When the main reason for buying is to profit from rising prices, or, which is the same thing, to buy before rising prices make ownership unattainable, the only justification for buying at sky-high prices is expectations of further rising prices. When that expectation is eliminated, buying quickly dries up, while those who expected rising prices to cover their interest and depreciation costs come under increasing pressure to sell. A self-reinforcing process works the same way on the way down as on the way up. Authorities may or may not have a few more tricks up their sleeves to arrest the decline in Chinese housing prices and set off a new round of speculative buying, but even if they do, it can only be temporary." End quote. Beijing may only be awakening to the true depth of this challenge now, however. One Beijing-based government policy advisor quoted by the Financial Times in a separate piece is reported as expressing the top leadership had underestimated the impact of the real estate meltdown on the broader economy. The situation may get worse before it gets better. End quote. We will continue following the property crisis from both the supply and the demand side, and the regulatory reaction from the central and local governments over the coming months. Okay, this is the end of China Update for today. I have one last thing to say, however, for the Australians and New Zealanders listening, if they care to stay but a few more moments. And of course, anyone else who cares to listen is very much welcome to stay too. But for those of you who are only interested in the China content, please feel free to end here. Okay, today is Anzac Day. Today we especially remember that we enjoy our incredible wealth and freedom and dignity in large part due to the sound decisions and tremendous sacrifice of those who came before us. We honor their memory and we commit ourselves to protecting and strengthening the systems which they have bequeathed to us, and to hand them to those who will come after us. To my grandfather who, with his countrymen, his Aussie and Kiwi and British mates, fought the armies of fascism in the deserts of North Africa and in the hills and streets of Europe, I am deeply grateful to you, sir. I am grateful too that you were as great a father to the man who raised me as you were a patriot to your king and country. To our brothers and sisters in Australia, I know we don't always agree, but our nations together were baptized in the same fires of war over a century ago, and we have stood with each other now for well over 100 years, and in a century from now, may we still stand shoulder to shoulder, as partners, as mates in the world. Happy Anzac Day.